How do global oil pipelines influence commodity supply chains? Imagine a network of giant tubes stretching across countries and continents, quietly moving millions of barrels of oil every day. These are global oil pipelines, and they play a huge role in how energy commodities reach markets around the world. They are like the veins of the energy industry, carrying crude oil from where it is drilled to refineries and then to consumers. Their influence on supply chains is more than just transportation. It shapes prices, availability, and even regional economies. Pipelines are a cost-effective way to move large amounts of oil over long distances. Compared to trucks or trains, pipelines can carry hundreds of thousands of barrels daily at a lower cost. This efficiency helps keep transportation costs down, which can stabilize prices for oil and refined products. When pipelines run smoothly, they ensure a steady supply, making energy markets more predictable. If a pipeline faces delays or damage, it can cause shortages and push prices higher. They also connect oil-producing regions like shale basins or offshore fields directly to refineries and export terminals. This regional connectivity means that if a pipeline is working well, it guarantees a reliable flow of crude oil. But if a pipeline is disrupted, it can create bottlenecks, leading to supply shortages that ripple through the entire supply chain. For investors, the capacity and reliability of pipelines are key indicators of how secure the supply of energy commodities is. Pipeline infrastructure can influence market prices by controlling how much crude oil flows into different regions. For example, if a pipeline is built to connect a cheap oil source to a major refinery hub, it can give that crude a cost advantage. Conversely, if geopolitical issues or sanctions block a pipeline route, it can restrict supply and cause prices to shift. Changes in pipeline capacity or route restrictions can alter regional supply and demand, impacting global prices. Building and maintaining pipelines takes years and requires large investments. Sometimes delays or underinvestment can limit the ability to increase supply quickly when demand rises. These long development times mean that pipeline projects are long-term assets that shape future supply capacity. If a pipeline project is delayed or canceled, it can restrict the growth of supply, affecting prices down the line. Pipelines are also part of a larger global system that includes shipping, storage, and refining. Geopolitical events or trade policies affecting pipeline routes can disrupt this system. For example, conflicts in regions with key pipelines or sanctions on certain countries can cut off supplies. For investors, understanding these risks helps assess how stable or vulnerable the supply chain might be. The midstream sector, which manages transportation and storage, relies heavily on pipelines. These pipelines help move crude oil from upstream production sites to downstream refineries and markets. When pipelines operate efficiently, they reduce bottlenecks, keep inventories balanced, and allow markets to respond quickly to changes in demand. Finally, pipelines face risks from physical damage, environmental concerns, or regulatory changes. These risks can temporarily or permanently disrupt supply. To reduce these vulnerabilities, companies often diversify transportation methods and invest in pipeline maintenance and expansion. For investors, keeping an eye on pipeline developments, regional supply dynamics, and geopolitical risks is essential for making informed decisions about energy commodities. In the end, global oil pipelines are the backbone of energy supply chains. They influence how much oil is available, at what cost, and how quickly it can reach markets. Their capacity, reliability, and the political environment surrounding them directly impact commodity prices and investment opportunities. Understanding these pipelines helps investors see the bigger picture of energy markets and make smarter choices.